I'm about to show you my full investment portfolio at 35, every stock, every ETF, and I'm going to break down how much each of these investments pay me in dividend income, all the way from 0 to 11.5% a year. Now, some of my investments haven't worked out exactly how I would have liked, and you know what, I'm going to show you those as well, fully open and transparent, and then we'll add up each dividend until at the end where you'll see how much this portfolio pays me in passive income a year. So let's get started. Now just remember, I'm not a financial advisor and nothing in this video is financial advice or a recommendation to buy or sell any investment. Let's start with the investments that pay me the least, and we'll work our way up to the ones that pay me the most, and you can follow this tally here in the bottom left that will show the running total of my dividend income per year as we go along. And just to let you know that the top 3 pay me over half of my entire passive income for this portfolio, so stick around until the end for those. Right, my lowest paying investment is of course my £1 a day investment pie that automatically invests £1 every day into the Vanguard FTSE All World ETF, or ticker VWRP. This pays me £0 in dividends because it's an accumulating fund that automatically reinvests any dividends into that fund. So £0, moving on. Next up, JP Morgan paying me £3.60 a year. Now this is a tiny position and a low yield of around 1.7%, but what's interesting is JP Morgan just passed the US Federal Reserve stress test, and they've announced plans to raise their dividend by 10% later this year alongside a $50 billion share buyback. That would be their 15th year of raises in a row, so small money for me but growing money. Then Pepsi at £4.60 a year, and Pepsi might be a small dividend, but it comes with a great track record. This year, Pepsi announced its 54th consecutive annual dividend increase. So they have raised the payout every single year since the early 70s, through every crash, every recession, everything. That's what makes them a dividend king. The share price, however, has struggled, as I covered last week, but the income keeps ticking up and it pays 4.2% a year. By the way, all of the data in this video is from the S&P Global Market Intelligence at the time of recording, but remember that dividend yields change, so be sure to check out the latest figures. The iShares China Large Cap ETF pays me £14.37 a year at around 1.8% yield. Nothing exciting. This one's in the portfolio, hopefully for growth in the long term, but not necessarily for income. Then London Metric, my smallest proper holding. But look at this, £17.17 a year from just £235 invested. That's a 6.6% yield, the second highest in my whole portfolio. They pay quarterly, and this year they raised their dividend for the 11th year in a row. Their CEO says they're now, quote, a step closer to dividend aristocracy. I like this little company a lot. Then my 2 world index funds. The Vanguard All World Fund, VWRL, pays me £18.45 a year, which is a 1.3% yield, and my single biggest holding, the Vanguard S&P 500, over £2,200 invested, pays me £19.64. Less than £1 more than the tiny London Metric from 10 times the money. The S&P 500 only yields around 0.9% at the moment because American companies mostly reinvest their profits for growth instead of paying them out. So it's a regular growth engine for me, but nearly the bottom of the list for income. Okay, we're getting to some bigger ones, I promise. Next is Aviva, paying me £52.21 a year, a 6% yield. Aviva pays twice a year, and this year's final payment was raised by 10%. That's their 5th year in a row of increases, and on top of the dividend, they've started to buy back £350 million of their own shares. This is exactly the kind of boring, cash-generating British company that I love. Alright, let's talk Lloyds Bank. £65.77 a year and paying 3.2% in dividends. Now Lloyds was my #1 stock for growth last week, up around 75%, and that means that 3.2% is the yield it's paying right now in the market. But on the money I actually invested, on my average purchase price, the yield on cost that I'm receiving is 5.7%. Their total dividend for last year was up 15%, and that's the third year in a row they've raised it by 15%, so well above inflation, and it's been a great investment for me. Just by the way, if you're enjoying this video and you find it helpful, please remember to give it a like. It genuinely helps the channel and I'd really appreciate it. Right, HSBC is similar at £72 a year, which is a 3.7% yield, but once again, taking the 74% growth into account, that's a 6.6% yield on cost, aka the money that I invested. It's a good reminder in investing that the company can raise its payouts, but your buying price never changes, so your personal yield just quietly climbs year after year. That's the building effect of holding dividend payers for the long term. Now the top stocks. Simon Property Group, £93.20 a year from the retail giant of America, so they are paying a 4.1% dividend yield. In May, they had some fantastic results and Simon raised its quarterly dividend by just over 7%, and the first payment at the new rate landed at the end of June, which of course I received. Between their record occupancy levels, the raised price guidance from analysts, and now a raised dividend, it shows that shopping malls are still kicking. Now, everything left on this list pays me dividends every single month. But before I get to those three, if you're looking to get started on your own investing journey, or perhaps even if you want to just open a new stocks ISA, well, Trading 212, the sponsor of today's video, are offering all new customers one free fractional share valued up to £100 when you scan the QR code up here on the screen or click on the link in the description below in order to help you get started. Alternatively, if you do enter the promo code CASH within the app and just deposit £1 into your account, you'll still qualify for that free fractional share. Right, back to the countdown. So these last three investments pay me 12 times a year each. That's 3 payments between them every single month, like a second smaller salary. And together these three make up over half of my entire passive income from this portfolio. First of the monthly payers is Realty Income, £99.72 a year, or about £8.30 every month, which is a decent 5.1% yield. This company is literally trademarked as the monthly dividend company. They've now declared 672 consecutive monthly dividends, and last month they announced their 135th dividend increase since listing in 1994. They've raised it every year for over 31 years straight, which makes them an official dividend aristocrat, and it's been a long-standing part of my portfolio. Second is EPR Properties, £116 a year, or around £9.70 a month, at a 6.2% yield, but the yield on cost for me is 7.4%. So these are the cinemas, ski resorts, water parks, and now 6 additional amusement parks that they just bought. This year, with earnings growing nicely, they raised their monthly dividend by 5.1%, so a fun portfolio of properties paying a very serious income. And now, my single biggest income payer is QYLP, the Nasdaq 100 covered call ETF. This one fund pays me £210 a year, that's £17.50 a month, and on its own, it's 27% of my entire passive income. So more than the S&P 500, more than Lloyds, more than HSBC, in fact, more than all three of them combined. And that's from a holding of just £1,722. And if you do the maths, you'll see that the dividend yield is a very large 11.5% a year. Now, how does that actually make sense to pay a dividend yield that high at nearly 1% a month? Well, the quick version is this fund holds the Nasdaq 100, but every month it sells options against those shares. That basically means it sells away most of the future price growth, and in exchange it collects cash premiums, which get paid out to me as a monthly income. That's why last week you saw it had barely grown in price, and where I said the growth isn't the point. This right here is the point of this fund. It converts the Nasdaq's potential into cash in my account every single month. Now, to be honest, those distributions aren't fixed. They move around month to month, and if the Nasdaq crashes, this fund still falls with it and the income doesn't protect the capital. So this is a deliberate capped slice of my portfolio doing one specific job, which is to pull in income. So as you can now see, if we add up every payment we've just been through, the 4 pence, the Dividend King, the boorish British insurers and banks, the American property giants and the 3 monthly payers, this portfolio is now on track to pay me £787 over the next 12 months. That's £65.56 a month on average. So that's while I'm sleeping, while I'm on the beach, while I'm traveling or paddleboarding, completely passive and completely tax-free inside the ISA account, just for holding what I already own. Typically, I'll just reinvest the dividends for now, but it's nice to see what monthly expenses the passive income can cover. So for this amount, it would cover my Wi-Fi, my cell phone contract, Netflix, Amazon Prime and YouTube Premium, all together with a little bit left over. Now, to be real, of course dividends are not guaranteed and neither is their growth. Companies can always cut their dividends, as many did during COVID, but that's why I choose to spread them out across different companies and industries, although I could probably do better to diversify a bit more away from property and finance companies, but so far I've seen some good results with them. But the plan itself doesn't change. I keep looking to buy good assets with good track records. I pound cost average over time and I hold them for the long term. Then I just hold tight, have patience and let the yield on cost quietly climb so that each year the income can cover more and more of my real life bills, and every bill it covers is then a little bit more of freedom that I bought for myself. But guys, that is it for today's video. I hope you enjoyed it. Let me know in the comments, good or bad, if you think I should be doing anything differently or which dividend stocks you like that I maybe don't have. Subscribe to see more videos like this one, and I'll see you guys next Wednesday as always on Casual Cash. Cheers.